Welcome to the Explainer. Today, we're digging into a super common trading mistake that can really hurt your account, confusing the pretty patterns you draw on a chart with what the market is actually doing. So, let me ask you this. You've seen a breakout, right? You get excited, you jump in, you're thinking, this is it, this is the big one, only to watch it hit the brakes and completely reverse on you. It's got to be one of the most frustrating things ever. Well, today, we're going to break down exactly why that happens and how to stop falling for it. All right, first things first, let's shine a spotlight on this classic trap that gets so many traders into losing positions. I bet this looks familiar. You see the price punch right through a trend line, maybe a channel you drew, and the first thought is, okay, time to go, this is the breakout. Our source material calls this a pattern break. But then, what happens next? The momentum just vanishes. The price stalls out and reverses right at that last peak, the actual market structure. And just like that, you're stopped out, scratching your head, wondering what just went wrong. Yep, that's the trap. So why? Why does this keep happening? It all boils down to a really important difference between the lines you draw on your chart and what the market is actually doing. The whole key here is to get the difference between a pattern and the market's real structure. And that leads us right to the core idea of this whole thing. Once you get this distinction, it can totally change the way you see the market. The instructor from our source puts it perfectly. When a line we have drawn breaks, it is called a pattern break. When the previous high or low breaks, it is called a structure break. See, one is all about our perception, our human imagination, and the other is about the market's raw, unfiltered behavior. So here's the bottom line. A pattern break, that's just a line getting crossed. It's based on trend lines and channels we decided to draw. But a structure break, that's the real deal. That's a fundamental change in the market's trend because the price has broken past an actual high or low that it created. Think of it this way. Trading the pattern is like trading a map, but trading the structure is trading the territory itself. Okay, so this is all great theory, but how do you actually use this to stay out of that trap? Well, it all starts with a simple but really powerful rule of thumb. Just remember this number, 5%. Think of this as your first line of defense. It's your little guide to help you decide if a pattern break is even worth looking at. The rule is super straightforward. Step 1, you spot your pattern break. That's the line you drew. Step 2, you find the real deal, the structure break, that next swing high or low. Step 3, you measure the space between them. And here's the rule. You should only think about entering on that pattern break if the gap to the structure is bigger than 5%. And believe me, that 5% isn't just some random number. For one, it makes sure there's actually enough room for the trade to breathe and become profitable before it smacks into that structural wall. And just as important, it helps cover your transaction costs, what our source calls your break-even point. Every trade has costs, right? Commissions, fees. Without that 5% cushion, you could be right about the direction and still end up losing money. Now, beyond just rules, you can also learn to read the signs of a real market reversal. The source material has this fantastic analogy for it. It's just like making a U-turn in your car. Just think about it for a second. When you make a U-turn, you don't just yank the wheel, right? Of course not. First, you slow down. In a market downtrend, that's when the new lows start getting closer together. Momentum is fading. Second, you stop. The price stops making those lower lows and makes an equal low instead. Third, you actually turn the wheel. And in the market, this is when the price makes its first higher low. That's a huge signal. And finally, you hit the gas and accelerate in the new direction, breaking that old structure. The market is basically telling you what it's about to do. So what if you miss that first breakout? Do you chase it? No, absolutely not. What you need is a complete game plan, a set of clear priorities. You've got 4 clear chances here. Priority 1 is that initial breakout, but only if it follows our 5% rule. If you miss it, no big deal. Your second priority is to wait patiently for a retest. That's when the price comes back to say hello and confirm the breakout level. If that doesn't happen, priority 3 is to wait for some consolidation, a little pause where the market catches its breath and builds energy. And if all else fails, priority 4 is waiting for the price to come all the way back to that original breakout point. See? The key is patience, not panic. So it all comes back to this one fundamental question you need to ask yourself on every single trade. Are you trading the lines you draw, or are you trading the structure the market creates? By focusing on the market's core behavior, the territory, not the map, you can start trading with so much more confidence, so much more clarity, and hopefully, you can finally say goodbye to those frustrating false breakouts for good.